Today I would like to analyze Procter Gamble, one of the largest consumer goods company in the world. We can see in the 5-year charts we are up around 35%. So today we're going to take a look at the financials to find out if this company is a good buy right now. The first thing we can recognize is a huge market capitalization of 397 billion US dollar. So this makes Procter & Gamble the largest consumer good company in the world by the market capitalization. We also have a dividend yield of around 2.5%. We can see here the dividend did increase many years in a row already. So this is something we really like to see. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 71 billion US dollar. This was around 5% increase from 2019. Then in 2021, we had a 7% increase, not bad. Then 2022, around 5%, 2023, around 2%, and then 2024, around 2.5%. So overall, what can we say? I think we had some good growth in 2021, but now we also see the growth is slowing down. So this is something we don't like to see, but overall, it still would be a check here. We had a growth in the last 5 years. The next thing I'm looking for is free cash flow growth in the last 5 years, a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see here in 2020, the free cash flow was around 14.3 billion US dollar. This was a 20% increase from 2019, so very good growth. Then in 2021, we had around 9% growth. This is also not bad. Then 2022, around 13% decline in the free cash flow. 2023, around 1.6% growth. And then 2024, around 20% growth. So overall, what can we say? We had some good growth, especially 2020 and 2024. So it's a check here and it's something we like to see. The next thing we're looking for is the free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we want to see that number high. So what we're going to do now, we're going to take the free cash flow from 2024, around 16.5 billion. We're going to divide it with the current market capitalization, 397.5. So then we're going to get the free cash flow year for 2024. So the number we get is around 4.15%. So it's not a bad number, I would say. It's over 4%, so it's a check here. But for me, it's also not an extreme indication that this company is undervalued right now. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025, the free cash flow could be around 16.4 billion US dollar. In 2026, around 17.2 billion US dollar. In 2027, around 18.2 billion US dollar. So let's assume for 2027, it could be around 18 billion US dollar. So we're going to take this number. We're going to divide it with the current market capitalization, 397.5. So then we would get the free cash flow yield for 2027. This would be around 4.52%. So we can see already the free cash flow yield would improve. So it would look more undervalued with this free cash flow. But I think it's still not a very high indication for undervaluation right now. The next thing we're looking for is the debt to free cash flow ratio under 5. So this means the company can pay back the debt with the free cash flow in under 5 years. So a very important number as well, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take a look at the long-term debt first. So we can see here around 25.6 billion. And then we're going to take a look at the short-term debt as well. So the short-term debt we can see here around 3.38. And this number we need to take as well. So all in all, how much is this? So this would be around 7.2 billion US dollar. So this we're going to divide then with the current free cash flow. The current free cash flow around 16.5. So then we get the number that we are looking for. So the number we get is around 1.98. So this means in a little bit under 2 years, we can repay the debt with the free cash flow. This is a good number, so as a check here. Then we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 9.5 billion US dollar. This is also a good number, I would say. So overall, all in all, I think the balance sheet is looking quite good. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the ratio, the higher the indication for undervaluation. So we want to see that number low. So what we're going to do now, we're going to get the enterprise valuation first. So this is the current market capitalization. So this is around 397.5 plus the debt. So we need to take a look at the debt. So this is 25.6 here. Then we need to add the short-term debt as well, 7.2. So this would be around 22.8 for the debt. We're going to take the cash off. So the cash around 9.5 billion. So this was then give us the enterprise valuation of this company. So let's calculate this quickly. So the number we get is around 410.8 billion US dollar. So this would be the company with including the debt and minus the cash. The next thing we're going to do is we're going to divide it with the current free cash flow, around 16.5 billion. So the number we're going to get is around 24.9. So this number is under 25, so it's a check here. And this is something we like to see. So overall, I think this company doesn't look extremely undervalued, but also not overvalued right now. We can also calculate this number with the free cash flow assumptions for 2027, so the 18 billion US dollar. So we're going to divide the 410.8 billion US dollar with the 18 billion free cash flow. So we're going to get a different number for 2027. So the number we get is around 22.8. So I think if the free cash flow keeps growing, this company can look fair valued right now. The next thing we're looking for is the shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially we think the company is undervalued. So we can see here, this company did a lot of buybacks in the last years, especially 2021 with around 4% decreasing shares outstanding. As well 2023 with around 2% decreasing shares outstanding. So overall, as a check here, this company buys back their own shares, and I think they can afford it as well. The balance sheet is looking quite good. I would like to give my conclusion about this company, so let's start with the positive. So we had some good revenue growth in the last 5 years. We also had some good free cash flow growth as well, so this is something we like to see. I think we have a good balance sheet here, which means a low amount of debt and a good amount of cash on hand. So then we have the free cash flow yield around 4.15%. So to me, this is not really looking undervalued, but is also not looking overvalued. So I think this can be around fair value to me. Then we have the enterprise valuation to free cash flow ratio around 24.9. So again, I don't think this company looks extremely undervalued, but also not very overvalued as well. So I think this company wouldn't be a buy right now, because I think there are other companies that are more undervalued at the moment. If you found this video helpful, don't forget to like and comment and subscribe for more content.